In today's video, I talked to Mark. Mark is 62 years old with 3 different rental properties. Tune in as we discuss how he should calculate performance on those properties, how the properties fit in his overall retirement income plan, and how those properties ultimately will allow him to retire significantly earlier than he ever thought possible. Joining me on today's Retirement Makeover is Mark. Mark, thanks for being here.
Hey, James, it's great to be here. So thank you. I look forward to this.
Well, thank you. You have a lot of real estate. You
I do.
have a lot of different accounts, whether they're 401ks, IRAs, brokerage accounts. You are starting to think about retirement and wondering some things. Do you mind
Sure.
sharing some of the questions or challenges you're facing as you prepare for retirement?
Yeah, James, I think, the biggest question for me is, I do plan to work till 70. And, what will my financial situation look like at 70? I kind of know what my expenses are now per month, but, when I retire, I don't want to live on just covering my expenses. I want to do some things, right? So I think from you today, if you could say, hey, Mark, based on all the financials that you supplied, your situation, I think at 70, this is what you could safely pull every month or every year and live on. That would be a lot of weight off my shoulders on that one. That would be great to know. And there's another one too. It's the real estate that I own, right? I have a scenario or a situation where I have a 3-unit apartment building. I have to do improvements on it, but I can also add 2 more units on to that. So should I take all that cash I have and do that, or just do the improvements and invest the cash? So if we can kind of look at those two, that'd be great.
I think we can certainly look at those too. And I think the real estate is going to be a core piece of your plan, given there's a few different properties and
Yes.
potential to add on, potential to create more income. Real estate is such an interesting thing in that it's an asset by itself. It can
Right.
also generate cash flow, of course, for you, which can fully support retirement. It can
Hmm.
partially support retirement. It can be used to sell and purchase other things, exchange and purchase other things. So what I'm going to start with, Mark, is that piece, is the real estate piece of how do we look at real estate, not just generally speaking, but as people preparing for retirement. What can that do for us in retirement? We're going to start with that. And then we're going to tie that into your specific plan to see how can this best be utilized to create more income in retirement, to
Right.
retire earlier, to just create more possibility to protect surviving spouse. That's always a thing of how do I make sure that I'm okay, as well as my wife, who in
Yeah.
this instance is a bit younger. All of those things are things that we're going to cover. And I'm going to start just by going over a high level view of where you stand today. So you've got various different accounts. You have cash in the bank, of course. You mentioned some of that can be used to take a property that you have, add on to a property, add income. So we can come back to that in a bit. You
Right.
have various investment accounts. So IRAs, Roth IRAs, joint accounts, so on and so forth. You have about $1.8 million combined between here. But the big thing is the property. So you, of course, have your primary home that you live in. And then
Right.
you also have a few rental properties. You have 3 different rental properties here that are creating income. And you've gone in here and you've input what you purchased them for, what the value is. And what we're looking at here is what's the rent on these and how can we use this to determine how does real estate fit into our overall plan. So I'm going to go through a bit of a how would I approach that first, Mark,
Okay.
generally speaking, for all of us to look at. And then we can bring that back and tie that back to your plan specifically. Does that sound okay?
Yeah, that'd be great.
Perfect. So let's go here. Real estate is hard sometimes to know what's the return on it. We all know that person. We talk about, okay, my parents bought a home 30 years ago, or I bought a home 30 years ago, and it went from 400,000 to a million or whatever it is. And we have to ask ourselves, that's a big number, but what's the actual return on this? And how do we think about real estate, not just in terms of the rate of return, but how does this fit into the retirement decision that we're going to make? And so for all of us, the things that we need to look at is if we're going to have real estate, and specifically rental real estate. I'm not talking about the home that you live in. I'm talking about real estate as an investment. What is driving that return? And there's 4 components that we're going to cover. One is just rental income. So you own the asset and you get rent for doing that from renters, from tenants. There's property appreciation. So of course you buy a home and ideally over time that home goes up in value. There's leverage, a component of leverage, which is when you borrow money to do this, it can skew the returns upwards or downwards, depending on how things go. And then there are tax benefits. So to start with this, I'm going to start with rental income. And Mark, we're going to use that first property that we listed or that you listed here. You have
Okay.
one rental property. Value of 1.55 million. What's the expected return of that? How can we start to say, is this a good investment? What's this going to do for you? We need to go through each of those four components of return. So when we look at this, gross income that you had listed there was a little over $6,000 per month. So that
Right.
comes out to $72,300 per year, assuming full tenancy. So no vacancies, no gaps in turnover, just $72,300 per year. And there's expenses with that. The expenses that you listed are property taxes, there's insurance, there's maintenance total here. Now there could always be one-off things, but just from what we're looking at, that comes out to $13,500, which means your net income is $58,800. If we divide that by the current value, now you can divide this by the current value or the purchase price, depending on what rate of return you're looking at over what period. I'm looking at from today onward with that asset value. That's a net income of about 3.8%. Now, I think of this almost like a dividend from a stock. Okay, if I'm going to buy a stock, right, what are the components of my return? Well, there's really only two. There's what's the cash dividend it's paying and what's the appreciation. With real estate, this is kind of like that dividend. The net income is a percentage is 3.8%. So that's one component of returns. The second is property appreciation. Okay, well, we don't just buy a home and the asset value stays fixed. You've done quite well on this home already. It's appreciated significantly. What we're looking at here is, well, what's that going to look like going forward? Impossible to tell with any certainty. But what we do know is from 1928 to 2023, based on the Case-Shiller Index, properties across America have appreciated by about 4.2%. Now, the hard thing with this number is that's not evenly distributed. I know some of the areas that you own homes, if you're in areas like San Diego, if you're in areas like San Francisco, New York, those home values have appreciated significantly more than this 4.2%. Other parts of the country have not come close to this. So this isn't to say that all areas are created equal in the sense of what you can expect from property appreciation. This is just one data point I think is important for us as investors to be aware of. The second thing is if we just look at asset or annual asset class returns by decades, this is from Ben Carlson, A Wealth of Common Sense, which is an awesome blog that I think everyone should read and be aware of. But what he goes through is looking at the decade, how have various asset classes performed? Well, if we look at the 2020s, it's been an incredible decade, which I think as a real estate investor, this has skewed things because we all have a little bit of this recency bias of, well, look how much this is appreciated in 3 years and 4 years. Well, an annual return of 10.2% is pretty darn good when that's just one component of your return. And then you also get rent and some other benefits along with this. So when you look at real estate by decade, generally speaking, there have been other times when it's been a high rate of return, like the 1970s, but keep in mind, inflation was 7.4%. So the real return was 1.3. Or in 1940s, 8.1%. Real return was about 3, a little less than 3. So it is absolutely something that appreciates in value. I just want to point out that when making these projections of what is it going to do going forward, we have to be mindful of how things done historically, not just this skewed perception of what the last 4 or 5 years looked like. So that's one thing. Now, for the sake of this, Mark, I should turn this back to you. Do you have any thoughts when you look at your properties? Is there a number that comes to mind that you think of in terms of appreciation or what you might expect?
Yeah, because of where I live, James, we've seen the appreciation just skyrocket, right? When we purchased this building in 2012, the real estate market was still highly depressed at the time and was just about ready to make the turn. So I think the appreciation, you said 4.2, right? I think that's what you mentioned previously. That would be great if it did 4.2. I think it'll do slightly more because of where I'm located, plus the desire where it's located. And, I have not had an empty unit for 10 years in this building. So it never turns over. So I think the appreciation will continue to go up, probably slightly above what you projected.
Well, Mark, you and I didn't coordinate before this, but that works out because the assumption I'm making is fine. And again, this is more of an assumption for planning purposes, for illustrative purposes, more than obviously a prediction what will actually happen. But let's assume 5%. So if that, well, then when we go back to what drives returns, if we're just looking at income and appreciation, so the cash return, and then just the appreciation of the building itself, well, we can look at that from on this first property that we're looking at, the income is like an annual return of 3.8% when we look at the net income after expenses. And if you do get a 5% return, then the total before leverage and taxes, we're going to cover that in a second, is about 8.8%. Now, when we do look at that, and before I go there, we can't not consider leverage. We can't not consider tax benefits. Leverage,
Right.
this is actually the real reason that most people do really well in real estate. To use an example, if you buy $1 million property and you put 10% down, well, you put $100,000 down and you buy a property for $1 million, just to use a big round number. Well, if that property increases by 10% in value, it goes from $1 million to $1.1 million. Well, you as an investor didn't just get a 10% rate of return. Your rate of return doubled because you put $100,000 in and there's $100,000 of appreciation. Now, there's some financing costs, there's some other costs, there's some things that would skew that a bit, but that's how leverage works. When things are going up in value, because you're not paying cash for 100% of it, at least typically not, you are getting outsized returns on the way up. Now, the same thing can happen if prices go down. That's how so many people lost their shirts in 2008, is they were overly leveraged. Things went south. They had to sell the property and they owed more on the property than the property was worth. But in general, with prices going up, leverage increases this the IRR that you might look at, internal rate of return, if we're looking at a real estate project. And then there's also some tax benefits of depreciation. So when you receive income from these properties, you write off expenses against that. But there's also depreciation, which is like a phantom expense. We're not actually paying it, but it's a deduction against some of that income that comes in, which allows for you to keep more of that income because of the tax benefits. So that's a basic assessment. Now, for us, Mark, and for all of us really listening to this, how do we consider rental real estate? What are the final considerations? The first is that return piece. Not just what's the return going to be, but compared to what? Benchmarked to what? A nice thing that I like to look at, or just a starting point, is if you get a return of 6%, 7%, 8%, that could be a great return. But keep in mind that the long-term return of the S&P 500 is about 10%.
Right.
So I look at that as a hurdle of if we're not crossing that, because by the way, the S&P 500, we don't have to deal with tenants. We don't have to fix leaks. We don't have to deal with any of the stuff that you're just naturally going to have to deal with as a landlord. So if you're not crossing that, why? What's the reason that you're doing it? So you would hope to get some premium, and that premium is almost a hassle premium, a risk premium, a premium of it's going to take more of your time than a simple passive investment would. The second consideration is hassle. Talking about retirement. Do you want to retire and travel the world and never actually be in the United States? If so, that might be pretty difficult to maintain some of these properties unless you get, of course, a property manager, in which case some of that return is now diminished because that's an extra expense. Do you want the hassle or do you love it? I know people that are on both sides of this. And then finally, taxes. So even if the return wasn't great, well, if you were to sell this property that we just looked at, there might be a 7-figure gain on that property.
Right.
You sell it and pay the tax. Do you keep it simply because maybe the return's a little less, but you're getting the full asset value in terms of the income it's creating for you? Do you exchange it? So there's all types of things that we want to look at. But I want to turn this back to you real quick of how big of a hassle are these rental properties to you, and to what extent do you enjoy having them?
Yeah, James, it's not bad at all. I've been very fortunate with this building. I know I'm going to have to do the improvements, and we'll talk a little bit about that. It does need an upgrade on the electrical, the plumbing, and some other items. But the demand is so high. And plus, once I do all the improvements, very little can go wrong with this building. And very little has gone wrong in the last 10 years. So I hope I didn't just jinx myself. That's always in the back of my mind. Do I want to be a landlord? Is it smart to keep the properties and hire a management company and pay that fee? And, and that's where you need someone like yourself. I would need someone like you to come to say, hey, when I turn 70, what do I do, James? Right. And you can give the guidance at that point and say, hey, this is what it is. So I think right now I like it. I'm going to keep it. I'm going to go ahead and make the upgrades on it. Once I do the upgrades, there's not going to be much that building's going to need other than good tenants. And that's it. And I've been very fortunate with the tenants, have not had any issues, and we get along great. So I'm going to keep it for now and keep it going in the right direction.
Well, that's great to know, because what we're going to look at next, Mark, isn't just real estate generally speaking, but your specific real estate and your cash flow needs in retirement and how this fuels some of those or funds some of those. Because with this is going to change how you should be invested in the rest of your
Right.
accounts. This is going to
Yep.
change when you can retire. This is going to change how much you can spend when you retire. And that's what I want to focus on next is how does this actually impact you? So here's your different rental properties. You can see, I'm just going to go through this briefly in terms of what's the rental income coming in from each of these. So that's there. That's already plugged into the numbers, property taxes, expenses, et cetera. What we want to do now is say, what are the goals? What's this for? We don't just own the real estate for the sake of owning it. We don't just save the
Right.
401ks for the sake of doing it. We do it so that one day that can fund the lifestyle that we want to maintain without us having to go to work to earn that income. So here's your goals, Mark, of retiring at age 70. Retirement expenses of $8,000 per month. Now, these expenses you were sharing with me before we went live was it's hard to know exactly how much you want to plan on spending when you don't know what's possible.
Right.
Between Social Security, between real estate, between investments, until you can maybe know what those upper ends of the spectrum are, it's hard to dream of thinking like, well, what's actually possible? So we're going to go
Right.
over that
Yeah.
and cover that of how much could you spend based upon
Mhm.
that. We have some averages healthcare costs in here, what that might look like out of pocket in addition to your Medicare premiums. We plan for long-term care, just average cost of assisted living here you can see, but we're going to assume no long-term care here to start.
Right.
And we can then toggle that on and off. Um, Lifestyle, travel, vacation. We want to plan for an additional $15,000 per year, not forever, but for the first 10 years after retirement to say that let's enjoy what we've worked for. Let's make sure that we're able to do all the things that we want to do. So
Good.
those are the goals that you have. In terms of income, you've got a salary and a bonus that can cover everything that you need to spend today. In retirement, in addition to rent, you'll have Social Security and you're going to max out your benefit at age 70 and it'll be the fullest benefit that you can have. Savings along the way. So, Mark, you're saving 11% to your 401k. You do get a healthy match here, 7% on the employer side as well. So it's not just what you have in investments today, but what you're continuing to add to investments. And here's the interesting part is we want to say, okay, based upon all this, based upon what your goals are in terms of when you want to retire and how much you want to spend, based upon what you have today in terms of real estate, in terms of cash, in terms of investments, and based on what's going to happen along the way, which is the continued savings, the continued growth of your assets, what is that actually going to look like? Are you on track to be able to do all of this? And the reason we started with real estate is because real estate is going to be a pretty significant factor in all of this. So, Mark, when we start to look at your retirement cash flows, here's just combined income, you and Michelle for the next several years. We know that that covers all needs. We know that that covers the groceries, that covers the mortgage, that covers the stuff you need to spend money on. What we're always concerned about with retirement is where's income going to come from when that salary goes away, when neither you nor Michelle have any income coming in. And so that's where we want to drill down first. And what we can see is at age 70, you're going to have Social Security. Now, this is going to be partially your benefit. And then Michelle also will have her benefit that kicks in as a spousal benefit. You can see how that increases right here when her spousal benefit fully kicks in. And then we look at what's the total benefit that you would have. That's one source of income. The other source of income, and this is at age 70. And so this isn't what your income is today from real estate, but we're assuming some adjustments upward each year. You can see what does rental income look like at that point. And we cover rental income from all three of the different properties. I know one of the considerations is you have cash that you can use to immediately increase some of that so that in reality, this will look probably a little different than even what we're looking at right now. We haven't factored in expenses yet. We're just looking at the gross income. We'll factor in expenses separately. But when we look at a summary of this, we say here's Social Security, here's rental income. You have a total income of called $250,000 year one of retirement just between those two sources. Before investments, before anything else, that's just a baseline level of income. When we do compare that to expenses, which is the next thing we need to do, we say, okay, if that's our income, that doesn't tell us anything until we know what expenses are and how far is that income going to go. So with expenses, we have everything from living expenses. This is the $8,000 per month or $96,000 per year in today's dollars. And then we adjust that for inflation, which is why it continues to go up. Your housing costs. So that's the cost of the mortgage plus property taxes. you have healthcare costs, and then you also have the costs of the rental properties. Now, some of these, with the mortgages paid off, there's no mortgage, but there's still property taxes, there's still insurance, there's still the other expenses. So when we look at all of that, here's your total expenses between these three sources or four sources of expenses for you and Michelle, $8,000 per month in today's dollars, plus the cost to live in your home, plus the cost of healthcare, plus the cost to maintain the rental properties. We're looking at about $211,000. Now, the last thing that we want to do, or two last things, is one, we need to add on the separate goals. So, which is vacation in this case. The reason we separate this out is because we're not just lumping it in as an expense that you're going to have until age 90 or 95. You're only going to have this expense for the first 10 years. And then you see, we are assuming that expense goes away because you're probably not traveling the same at 80 as you are at age 70.
Right.
So when we look at that, that is another expense that we're planning for. And then finally, tax payment. So this is just an assumption based upon where money's coming from, what state you live in, of course. Is this a brokerage account? Is it Social Security? Is it an IRA? What's the projected tax bill that you're going to have? Hey there, just a quick sidebar as you're watching me go through Mark's plan with him. If you are interested in getting access to the same exact software that you see in front of you, you can access it below in the link to the Retirement Planning Academy. With that, you can plug in your own numbers, see your own projections, and ultimately see where you stand with regards to your retirement. So that we can say, here's your total outflows, this number right here. It says, Mark, Michelle, if you can generate, call it 264,000 to round up, then you can pay taxes. You can pay to fund the trips that you want to take. You can pay to maintain the vacation or the rental properties, I should say, that you have. You can pay for healthcare. You can pay for housing and end up with $8,000 adjusted for inflation to cover everything else that you want to cover. And here's the beautiful thing, and this is where so many different things stem from your decisions around real estate. What we look at next is what's called net flows. Net flows says, what's the difference, Mark, between how much you have coming in income, in this case from real estate and from Social Security? What's the difference between that and the total expenses that you're going to have at that time? 264,000. The difference, this tells us how much you need to be prepared to draw from your portfolio. Now, you have a portfolio today that call it 1.8 million.
Right.
That's going to continue growing, and that's outside of real estate. You're going to keep adding to it. If you're taking out $13,000 per year, even if your portfolio never grew, even if you never add another dollar to it, that's less than 1% per year of your actual portfolio that you need to take out, which is why when we start to go towards, okay, well, what does this look like holistically? When we tie all these moving pieces together, what does this look like? Well, you're projected to here's your portfolio today. And by portfolio, I mean invested assets, liquid dollars, cash and investments. Those are just going to keep growing until you retire in this projection. And by the way, this projection makes it look like the market's a lot calmer and cooperative than it actually is. The reality is this is still going to fluctuate quite a bit, but on average, your portfolio is going to continue growing. You're going to retire with, in this projection, call it 4.3 million in your invested assets. That number is not going to start declining as you withdraw. It's going to still continue to increase simply because you're taking $13,000 out of a $4 million portfolio. You're taking about 0.25% out of your portfolio each year, which means the remainder keeps growing. Now, if I were to ask you, Mark, my guess is you're not super fired up to say, how can I do whatever it takes to make sure I die with $14.2 million in the bank? And you know what, if I add in the value of property, make that a cool 26 million.
You know, my kids might be pretty fired up, James. And
I'll make sure they don't see this.
Well, they will someday, right? But yeah, that's so this is exciting. I mean, it says to me, hey, I'm in a good place right now. I'm going in the right direction. But then, all right, the next step is to say to you, all right, James, where would you, if you were my financial guy, be comfortable for me to withdraw from my investment accounts? And what is that percent per year? And where could I be? And this is exciting to see so far. So thank you. Absolutely.
Here's where my mind goes next as the financial guy. So when I look at withdrawal rates, here's your projected withdrawal rate. Like I said, 0.25%, 0.3%, 0.4% per year. It makes a big, and when I say withdrawal rate, when you're retired, this is the screen that tells us how much do we need to pull from your actual
Right.
portfolio. Because if you look at it, if we look at income sources in your
Mm-hmm.
plan, here is Social Security, as called the income base, the income floor in the purple. This
Right.
green is your rental income. The orange is how much you need to take from your portfolio to cover the rest. Tiny
Got it.
little sliver. Now that sliver gets bigger when you turn 75 because required distributions kick in. You're
Yeah.
going to be forced to take out money. But if we were to quantify this, it's a very little amount. Now, when we talk about your portfolio allocation, one of the questions is, well, how do I need to be invested with all this?
Right.
Real estate, to the extent that you have it, makes a huge difference in how you should be invested in everything else. There's a couple schools of thoughts on this. If you
Mm-hmm.
wanted to treat real estate like a pension, now I wouldn't
Mm-hmm.
actually do that, because if a pension or Social Security, it's there, it's guaranteed. You can make some
Right.
arguments against that, but it's there, which means that is safe. You can totally count on that. Technically, real estate could go away. If there was an earthquake, if there was a flood, if there was a major downturn, this income is not guaranteed. Maybe it's highly
Right.
probable that you'll continue to receive it, but it's not guaranteed. If we were to think along the lines of, okay, well, I'm comfortable planning on it being pretty darn stable, you don't, when you look at an all stock portfolio, for example, that sounds pretty dang aggressive if you're retired. Why would you be
Right.
100% stocks? Well, you don't own bonds because they grow a lot. Bonds aren't the thing that are going to continue to increase your growth potential over time. You own them for one of two reasons. One is you could call it income. Okay, bonds do provide some current income, but primarily you're going to own them because, generally speaking, now it's hard to say this sometimes coming off a year like 2022 when both bonds and stocks went down, but generally speaking, bonds are going to preserve or stay more stable when markets go down, even act almost like a counterbalance. So if markets go down, bonds tend to go up even more. So you do need to make sure you have enough money in something that's stable, something that's secure, so that when you retire and when the market drops by 20, 30, 40%,
Mm-hmm.
do you have something that you could draw from? Now, here's the thing. If you owned 100% stocks, the dividend rate on that might be 2% if you own a
Right.
diversified stock portfolio. Dividends typically are pretty resilient even when stock markets fall in value, which means if your withdrawal rate is less than 2%, you can't guarantee it, but you can, highly probable that you could simply live off dividend income, which means you could be all stocks if you are fully comfortable with that. And that's a big if, because for a lot of people, if you have that $4 million portfolio in retirement that you're no longer adding to, a 40% downturn, which will happen at some point in your retirement,
Nope.
that's a $1.6 million swing.
Right.
And to see $4 million go to 2.4 when you're retired, when you're drawn from that, that's not the most comfortable thing for a lot of people to go through. However, it's important for this conversation to say, let's assume, Mark, that you were comfortable with it. And then I'm going to
Mm-hmm.
actually check in with you to see what your thoughts are. Here's an interesting thought. What if you then made this a very aggressive portfolio? Because what we're assuming is, okay, Mark, you retire and you go to a moderate portfolio. Call it a
Right.
60-40, so we're not over projecting growth rates. Well, if you stayed in a fairly aggressive portfolio, it's not $14.2 million that you have left at the end of the day. It's a full $22.4 million that you have. So that's one thing, that the asset allocation becomes pretty different. Okay, so we looked at what would be different if you had a different investment allocation just because you have real estate, you could afford to be more aggressive. Cool.
Right.
There's more money left at the end of the day. What we actually care about isn't more money left at the end of the day. It's how can this impact decisions we make today? How can this impact our lifestyle today or in the
Mm-hmm.
future? And so one thing we'll look at is, Mark, what if you didn't do anything other than say, what if I stopped working today?
Mm-hmm.
What if
Right.
I never earned another dollar of income over the rest of my life? Well, if you looked at this, that's a pretty significant hit to your overall portfolio. But remember, it's not your portfolio that's funding most of your retirement.
Right.
It's real estate that's funding a majority of your retirement. Now, if we go to cash flows, what you're going to see here before I go back to this other page is you would be pulling a lot more from your portfolio. Before this was 12,000, 13,000. So you'd be pulling more from your portfolio, and the portfolio wouldn't be as large as it otherwise would have been at age 70 because you're, 8 fewer years of saving and growth to it. But it is still doable, at least when you look at this. Now, we'd want to double check and triple check and run numbers, but just this initial go at it, you're still very high probability of success if this number is accurate. one of the things you shared with me, Mark, was, okay, it's hard to dream about retirement, what it could be,
Right.
without knowing, like, is it foolish to think, what if we spent 10,000, 12,000?
Right. Yep.
Well, I'm going to ask you, given the option of putting in notice tomorrow, and I think you enjoy your work. I think you enjoy your job you shared with me, which is great, and maybe not what you're looking to do. Given that as an option versus continuing to work, not necessarily till 70, but continue to working for this foreseeable future and spending more in retirement, which is more appealing to you?
Uh, yeah, James, I shared with you. I love what I do. I add a lot of value to the company. The company values what I do for them. I enjoy it. It's 8 years away. It's going to go by so quickly. I like the idea. I could put my resignation in tomorrow, but the reality is, if anything, that might convince me, James, to say, hey, why don't I start working on that second career that you and I talked about, right? Why don't I get a little bit more aggressive with that? And then maybe I can eventually back away from the current company and go into my second career that we talked about. So I think this right here tells me, hey, yeah, starting in a couple weeks, I think I am going to figure out I know what that second career is, but how do I get there? And I think this really helps me and convinces me I can do that and walk away from my company. So I love the scenario. I think it's great. Yeah, I'm excited about it. But I just couldn't see myself walking away tomorrow, James. But it does.
Nor would I recommend it.
Well, Michelle might be a little upset if I come home tonight and say, hey, honey, I'm done. Actually, she'd be very supportive of it. She would support it 100%, no doubt. But that's not going to happen. But I am going to start looking at that second career that we talked about, James. And I'm going to look, how can I maybe accelerate that a little bit rather than wait until 70 to do that?
Here's something that might help in that decision.
Okay.
Is we looked at how do your cash flows change if you were to retire today? Literally don't go back to work after we do this. This net flow is another way of thinking of this. Isn't just how much do I need to pull from my portfolio? You could also think of it from the standpoint of how much do I need to earn in that second career to supplement existing real estate so that we're at least cash flow neutral. You aren't making major contributions to the portfolio, but we're at least not drawing money from it.
Right.
So the main goal of this sometimes is it stimulates those right conversations or thought process of what do I actually want life to look like? And you may say, hey, James, I love this. I talked to Michelle. We both think that it's actually best that I continue working until 70 because it fires me up so much and I get so much purpose out of what I do. I don't see myself leaving until 70. So let's go back here. That's great. But let's dream about what life could look like beyond 70. $8,000 per month is what you could spend under this. That was barely scratching the surface of what your portfolio could support. So hypothetically, what if you just doubled that? Now, that's an arbitrary number. That's me saying that, not you. But is this more travel? Is this more family support? Is this more giving? Is this more whatever you want to do? What might that look like? You could spend double, which again puts a dent into what the final portfolio value is, but you're still passing with just under $7 million in invested assets. You've really enhanced what your retirement can look like. And you still have all the real estate that is not even part of what this looks like. So
James, go ahead and crank that up to 20,000. Why are we stopping at 16?
Why stop there?
Why?
And for everyone watching, remember 20,000 is not just 20,000 total. It's 20,000 plus. We're already covering the mortgage, healthcare, taxes. This is $20,000 in today's dollars, Mark, for you and Michelle to get to spend. So as you can see here, that's where things start to say, okay, you could probably make it. Now, if we look at probability of success, it's a little lower. Now, here's what I might do instead, if I may. So, Mark, let's take this $8,000. Let's increase that by 50% and say, what if your base expenses increase by 50% to 12,000 for the rest of your life? We know that's possible because we already saw that doing that to 16,000 is possible. But what if we said the first 10 years of retirement isn't 15,000? But what if we took this and we made it much more significant? So it kind of balances out a little bit. Your entire retirement is looking really comfortable, but you're really living large for those first 10 years. And now what we're looking at is a situation where you're still extremely high probability of success, You could even take this number, and I'm just plugging stuff in at this point. This is just the benefit of the tool, though, is you can start to see what difference this would make. And you're essentially spending here $144,000, so $204,000 per year for the first 10 years of retirement, plus mortgage, taxes, et cetera, and then backing that down to the core of $144,000 per year from age 80 and beyond in this. So does that make sense there?
Yeah, it does. And again, part of this, James, and thank you for this. This is just very exciting information. And, it's opened my eyes quite a bit. Not only what I'm doing right now, but what I want to do in the future. And this is beyond, you save your whole life, you do the right things, and then you see this all out in front of you. I mean, it's just such a relief. So thank you for this. This is just amazing.
Wonderful. Well, I think that you did one of the keys to your plan is, yes, you've saved you didn't just fall into this. This didn't just happen one day. That you had the properties, that you had the assets, you've saved, you've done well. The real estate that you have has the ability to create significant income, gives you the ability to retire early, to retire today if you want to, or to significantly enhance what lifestyle could be for you in the future if you do continue to work. So with that, I think that you're in a wonderful spot, Mark. And I think the homework is for you and Michelle to talk and to say, what do you want your life to look like? What do you want work to look like? What do you want travel and adventure to look like? Because you're in a spot where you can support that.
Yeah, it's wonderful, James. So thank you very much for your time here and giving me this opportunity. And I just, this is priceless. It's one of those things. This is totally priceless to have this opportunity to be in front of you and for you to analyze this and to give me and show us the possibilities of what we currently have and what we're going to have in retirement. So it's a big relief, James. So thank you. I can't thank you enough.
That's great to hear. And thank you, Mark, very much for being a guest on today's Retirement Makeover. Appreciate having you on.
All right. Bye-bye.
Root Financial has not provided any compensation for and has not influenced the content of any testimonials and endorsements shown. Any testimonials and endorsements shown have been invited, have been shared with each individual's permission, and are not necessarily representative of the experience of other clients. To our knowledge, no other conflicts of interest exist regarding these testimonials and endorsements. Once again, I'm James Knoll, founder of Root Financial, and if you're interested in seeing how we help our clients at Root Financial get the most out of life with their money, be sure to visit us at www.rootfinancialpartners.com.